Please don't fall for the lies. The lies that the S&P 500 is the ideal long-term investment. That's what we should buy into every month. It's really not ideal at all. Have a look at this here. This is the S&P 500 versus the S&P 3. Now, I've talked about this on this channel before, so I won't go into too much detail. But the S&P 500 tends to underperform the top 3 stocks in the index massively and quite consistently. So here is the same on a logarithmic scale. We tend to see a very consistent outperformance of just holding the 3 largest stocks. And of course, those 3 large stocks tend to change over time. It used to be General Electric, ExxonMobil, and Pfizer, and now it's Nvidia, Apple, and Google. So we simply rebalance the portfolio once a year, and we buy the top 3 based on their market caps. And that outperforms very consistently. So here is the S&P 500 versus the S&P 3. Here is the S&P 3's outperformance over time. The difference is 17.7% versus just 10.5% per annum. And that compounds massively. $100 invested in the S&P 500 since the year 1990 would have returned $4,000 today. But in the S&P 3, it returns $42,000. So the difference matters. And so that's why this video, we're going to look into more details into the top 3, or let's rather say the top 1 stock. Let's have a look at Nvidia specifically. Because this strategy doesn't just work for the S&P 3, it also works for the S&P 1. So you can simply just hold the largest of the stocks instead of the S&P 500. But of course, then we invite quite a bit of additional volatility. Still, gun to my head, if I had to decide, do I want to hold always just the largest stock versus the top 500 largest stocks, I just go with number 1. And in this case, that's Nvidia. Hi, my name is Gerhard. I'm in the investment game for the last 8 years. I started this channel 5 years ago, and 3 years ago, I made my first million. On average, I outperformed my personal benchmark, which was Bitcoin, by an average 2% per month over the last 5 years. And so in this video, I want to share the data points that I look at in order to outperform the market. Now, what we see over here, that's Nvidia relative to the NASDAQ 100. It's not the Nvidia price, it's the Nvidia price divided by the NASDAQ 100. Now, why do we want to look at the relative performance? It's because whenever we make an investment into a specific company, our benchmark should always be the well-diversified portfolio, right? If we have the well-diversified portfolio, so the S&P 500 or the NASDAQ 100, then we tend to get the lowest volatility. So if we accept higher volatility by just owning one stock, we should also have expected outperformance. So that's why we look at Nvidia relative to the NASDAQ 100 in this case. And yes, Nvidia did outperform the NASDAQ 100 quite consistently over the years, but it didn't outperform that much recently, as in since June of 2024 to today, we've only seen roughly 5% outperformance. 5% over the course of 2 years is less than what we would expect based on our backtest. The S&P 1 on average outperformed the S&P 500 by 7 percentage points per year, not by 5% over 2 years. So is there maybe a way to potentially time this? Can we maybe use a moving average and then rather be in the NASDAQ 100 when we are below and be mainly in Nvidia when we are above? Now, when we follow such an approach, we of course need to have optimized taxes. We need to be freed of, say, a minimum 1-year holding period. So a strategy might not work for every private investor in every jurisdiction. But it's still an interesting thought experiment. What kind of moving average would have worked best to time the momentum in Nvidia relative to the rest of the stock market? I've run the numbers with the backtesting tool of this channel. I looked at all the moving averages from the 2-day up to the 200-day. And this here is the best moving average, the 54-day simple moving average. And surprise, surprise, that's the moving average that we are already plotting. And we can already see the issue. We tend to get a lot of bad signals, as in we buy high and then sell low again, and then buy high again and sell low again. We get a lot of bad signals by hovering around the moving average. So while the strategy did outperform just buying and holding, and while this did do an additional performance of roughly 4% per annum, that performance comes with quite some volatility. So maybe a better market timing approach is to look at golden crosses and death crosses, so the crosses of two moving averages. Whenever the short-term moving average crosses the longer-term moving average, we go long, we bet on rising prices. Whenever the short-term moving average goes below the longer moving average, that's when we are rather bearish on the asset, and that's when we sell Nvidia versus the NASDAQ 100. Again, I've run the numbers, all combinations of slow moving averages versus fast moving averages. This is the optimization plot, and the best combination is over here. It's the 14 versus 149 day simple moving average. The outperformance is not massive, but it's comparatively steady. This is our equity over time. And that's then how that looks like on a chart, right? We've got a faster moving average, the line in turquoise, and a slower moving average, the line in white. When we take away the price movements, it becomes a bit clearer. Currently, we should be long. We should rather bet on Nvidia than on just the general broader market, the NASDAQ 100. And since we're already talking about active speculation and getting in and out of the asset and preferring Nvidia over the NASDAQ 100 and vice versa, why not also introduce leverage? Because this is the big question mark for many people. What is the ideal leverage? Many people overutilize leverage. There is a place for leverage, but it has to be done the right way. Leverage is like fire. If you use a little bit of it, it can be constructive. If you use too much of it, the entire house burns down. And here is the back test. The optimal leverage for going long or short is 2x. Once we exceed 3x, we tend to get liquidated with our shorts. Once we exceed 4x, we tend to get liquidated with our longs. And everything beyond 2x tends to rather reduce our returns. But the 2x leverage then turns this return line into this return line over here. A bit more steady and also much larger in magnitude, right? We are at roughly 200k here and we are only at 100k here. Now we are not at 24% per annum, but at 40% per annum. But of course, the kind of capital that we invest into a 2x levered position is very different to the kind of capital that we just long-term dollar cost average into. But still, it's interesting to see what's at least historically optimal, right? How much we can potentially push it. Buying, say, a 3x levered ETF is probably not a good idea. If there is a 2x levered ETF, it might make sense. Sometimes. But again, this is all for active speculation. If you don't want to actively speculate, you can just stick to the S&P 3 or the S&P 1. You can just set and forget and buy the leading stock at any point in time. That used to be Apple, then it became Microsoft, and now it's Nvidia. The reason why I prefer the S&P 3 over the S&P 1 is simply because it outperforms more consistently, especially also in the recent past. Here's a comparison of all of the strategies. What's their annualized return? So the S&P 500 here as a benchmark, and here the different sub-indices of the S&P. What's our alpha that we get by holding that combination? And what's the volatility from that? What's the maximum drop down as well? And for the nerds among you, we've also got the Sharpe ratio and the beta. If you got some value out of this video, feel free to subscribe over here. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in Premium. In Premium, I share my personal approaches, how to beat the market. You also get access to all the backtesting tools that have been presented in this video. Thanks for watching and see you next time. Cheers.